Hello and welcome to Street Smart. If you want to learn about how to be smart with your money and learn about stock market investing, you are at right place. This is a small course which will give you information about stock market basics. With that, let's get started. Welcome to the Introduction to Stock Market short course, and this is the second video of the series. In this video, we will go over type of investors, long-term investors, quality, passive investment, active investment. So if we see like the stock price, it depends on type of investor, right? Like who is investing basically. So at high level, we know there are short-term investor and long-term investor. So who are the short-term investor? They are speculator or trader. So speculator can be bull, bears, lamb, or stage. So who are bulls? They believe that price of the given stock would go up near future. Peers would believe that stock price would go down in near future. Lamb are they don't know what they are investing. It is kind of someone who know kind of saw the meme that this stock is going to increase and they start kind of and the trend was there that stock price was increasing. So they enter and kind of the plan is to get profit from that trend. And then there is a stage. They they try, basically try to make money from very small difference in the stock price. They are the stage speculator and the trader. The trader can be three types, like depending upon the analysis. The one who does the technical analysis, um, sentimental analysis, and kind of there is a algorithm. It is basically a program in which the developer kind of assigns the develops a logic based on that it would automatically buy and sell in the market. So technical analysis, it is done on the charts and they use the different indicators like moving average, relative strength index, exponential moving average, those kind of indicators. And sentimental analysis is done based on purely on the news, what is going on social media, fear, greed index, etc. And the algorithm is kind of mean. The few of them are as there are many, but few of the technique that can be used is mean reversal, trend detection, and index rebalances. So what is done in mean reversion? When the price of stock deviate significantly from moving average, the algorithm get triggers to make profit, depending based on like if it goes up, then it would buy and sell at a higher price. And if it goes down, then it would sell and then it would it would be like kind of short selling. And then there is trend detection, which is purely based on stock price kind of fluctuating based on purely on trend, because someone like if it is the trend is like kind of they believe that stock price does not they believe that the price may move in series of up go down or down in the movements, like series of movements. And the index rebalancing is adjusting the weight of particular stock in the fund. It is basically like kind of adjusting the playlist, the music that you listen. And the long-term investor are passive and active. So who are passive investor? So passive, they buy ETF, index, and mutual fund. Shortly, we would cover in detail. And active is based on fundamental analysis, quantitative and qualitative. So here is the kind of long-term investor qualities. Avoid investing if you have a financial loan or credit card debt with a high APYs. No emergency funds saved for 9 to 12 months of your expense. Do not invest in meme stock. Do not understand the business model. Buy at highs and sell at lows. Do not need money for 3 or 10 years. Do not invest in hurry. Do not invest purely on others' opinion. Shareholder equity is negative. Debt exceeds the asset value. We will learn shortly what is that in this series. Company generating negative net income and free cash flow. The goal is buy at rational price, invest in easily understandable business that you should be that should have positive earnings for long period of time. Invest in few companies, portfolio diversification, patiently hold the stock till decided time period. So passive investment, the long-term investment strategy that mimic the stock market indexes. Exchange traded fund, that is collection of stock or index traded on exchange like a stock. So we can buy and sell the on a on market on a given day when the market is open, like when a semiconductor ETF. The mutual fund are kind of, you can buy at the beginning, at the end of the day when the market closes. So invest in the company that buys and sells stocks and bonds. For example, Vanguard and Fidelity. There you can open an account, which would directly, uh, from there you can directly buy the mutual funds. Index fund, it will track the performance of index, kind of. So they mimic the indexes. For example, Vanguard S&P 500 ETF, WU, which is the example of index fund. Then there is active investment that involves picking and choosing the investment individual stock or bond based on independent assessment of their worth. Step to make active investment. Circle of competence, which is basically the term given by Warren Buffett. It is the kind of, the knowledge within which you can invest. For example, someone kind of better to invest like what things or product that you are using, you are very familiar with that. For example, if you are a doctor, then you might not be familiar with the kind of technical tools and business. For example, doctor might have the circle of confidence to invest in software companies like Microsoft, Apple, or some kind of things, right? Same, if you are a software engineer, then you might be having a less knowledge about pharmacy, right? So yeah, that is the you need to decide what the circle of competence is. We would cover this in detail in next video. And then there is a qualitative analysis, business model, economic mode, management performance, industry sector, and this internal and as well as external. So what is economic mode, which is a term again given by Warren Buffett? It is like we can know how competitive does the company has its business model compared to its competition, and how they're able to generate profit. It is called economic mode. And then there is quantitative analysis to find the intrinsic value, and then if price market value is below that value, intrinsic value, we will buy and wait for given period of time. Thank you for watching. If you like this video, please like, share, subscribe to Street Smart, and see you in next video. Thank you. Bye.